Good morning, sir.
Good morning. Good morning, James. Good morning, all.
Thank you very much for doing this again. I know we've done it before,
Yeah.
but it is useful, I think, to come back and revisit these things. And I think for the sake of people that won't necessarily have seen you or heard of the fund before, maybe we could start off with you just introducing what Ecofin does and the Global Utilities Fund does and what it's trying to achieve, if you don't mind, please.
Yeah, sure, James. Thank you for the introduction. Yes, Ecofin, we are a specialist of sustainable investment. We've been around actually for more than 30 years in London. Assets under management, just above $2 billion. We still count in dollars. We very much aim at delivering high returns while also preserving the planet. So it's a combination of ecology and finance, as the name indicated at its foundation in 1991. I joined Ecofin myself about 15 years ago as a portfolio manager, and I'm particularly in charge of the strategy which follows your trust that we're going to talk about today. Ecofin, Global Utilities and Infrastructure Trust, launched in 2016, out of a strategy which actually Ecofin has been running in different formats for over 15 years. What I'm offering to do in the next few minutes is starting with a brief snapshot of the past performance. I'll introduce the main characteristics of the strategy, and then more importantly, I think I'll give you what we believe represents a significant and compelling opportunity to invest in the space at the moment, with some short-term drivers, but much more importantly, underlying medium and long-term supportive drivers of the universe and the strategy. So first of all, on this slide, past performance. As you can see, since 2016, the NAV has increased by a compound average of 11.5% per annum, 15.7% per annum for the share price. Last year, 2022, I think it's an interesting year. I'll come back on that. The NAV was up 5.7% and share price total return of 12.9%. That was for last year, calendar year 2022. We are showing some indices here for reference purposes, but we are clearly driven by a focus on absolute return, much more than trying to benchmark a portfolio clearly. Now, the next slide is a strategy overview. Next couple of slides. In a nutshell, so first of all, we only invest in listed equities. We have a global perspective to the space, and we want to both ensure some capital preservation to the portfolio and also gain some exposure to structural growth. When we say global, it's very much a balance between North America and Europe. We've decided to cap exposure to emerging markets at 10%. Not so much that we don't see opportunities in emerging markets, but much more because this is quite often with a different type of risk profile. So we tend to retain a pretty stable, relatively stable balance between North America and Europe for something like close to 85% of the portfolio. The rest of the world also accounts for a small proportion. Income is at the center of the upper part of the slide. This is referring obviously to the capital preservation characteristic and objective I was talking about. The portfolio typically yields around 4%. And you actually have a board which has proved supportive of dividend income and has even recently again raised the quarterly dividend of the trust. So income, clearly, but also growth. And what we mean by growth is much more about the structural underlying growth drivers of the space, largely related to the energy transition phenomenon. So we are hardly exposed to cyclical growth factors and much more interested in the long-term structural drivers. Typically, we expect our portfolio to grow its dividends by 5 to 7% per annum. So if you put those two on top of one another, a dividend yield of 4, with dividends growing at 5 to 7, you roughly get to double-digit total return per annum, which is within our objective of 6 to 12% per annum. That gives you an idea of the profile of the strategy. And as I mentioned as an introduction, so far, inception to date, we're pretty much towards the upper end of the total return objective. Investment universe, traditional definition of utilities and infrastructure with 3 subsegments: electric and gas utilities, with obviously a growing proportion of renewables; environmental services, that's mostly water and waste; and finally, transportation infrastructure with toll roads, airports, tunnels. What is the common characteristic between all those subsectors? This you can see on page 5, actually, the next page. We want asset-backed services based on long-term contracts. That's a precondition. Those long-term contracts give us high degrees of predictability of the future cash flows, and those predictable cash flows ensure sustainable and growing dividends, with actually also good inflation hedging characteristics as part of the universe and particularly of our portfolio. So obviously this type of definition implies that we do not invest in the equipment manufacturers that some people would typically include in infrastructure. We are very much interested in the asset-backed services part of the value chain. So that's for the main characteristics of the universe. Then moving to the why now, or the opportunity that we see, I would suggest that if you have one slide to remember from this presentation to keep in mind, is probably that one. Because I think this is a phenomenon which is largely underperceived, undervalued by equity investors. The fact that the typical business model of utilities has dramatically evolved over the past decade and continues to evolve. You see on this chart in the upper part of the slide that about 10 years ago, since 2008, you had close to 50% of the EBITDA of European utilities, 42% precisely in 2008, close to 50% of the EBITDA was stemming from conventional power generation activities. Conventional power generation meant very much fossil fuel driven and highly dependent on the external price of commodities. So that was a pretty volatile merchant business, up to 50% of the cash flows of those companies about 10 years ago. That proportion today has dropped to about 10%. This is a sample, by the way, of the 10 largest utilities in Europe. So it's fairly representative. This proportion has dropped to 10%, while today what is interesting is that you have about 80% of the EBITDA of those companies, which consist of either regulated networks or fully contracted renewables businesses. This is a major evolution, which has not only led actually to enhanced returns, but also maybe even more importantly here, which has led to a massive de-risking of the business model. And I think, again, this is a phenomenon which is largely overlooked, a phenomenon where Europe is ahead of the world. As you can see, so in Europe, you've got about a third of the EBITDA now of the largest utilities, which comes from renewables activities. It's less than 10% in the US. So the US, North America in general, and the rest of the world is only at the very beginning of that phenomenon, which we believe is highly supportive to the space. One last illustration of that phenomenon is what has happened here in the UK. You are all familiar with the fact that the UK used to drive the bulk of its power generation out of coal. actually was still close to 50% back hardly more than a decade ago. 2008, 48% of UK power generation was coming from coal. This proportion was less than 1% last year. So in about a decade, the UK has entirely phased out of its coal to transform its model into renewable, clean energy sources, including biomass for the case of Drax, which I'm sure most of you are familiar with. So this is a salient phenomenon, which we believe is one of the drivers of our strategy at the moment, definitely where we find the bulk of our alpha generation opportunities today, and I think it's a differentiating factor. Here is on this slide, thank you, James, what it means for the stocks which have succeeded in implementing that transition to a cleaner business model and adapting to the energy transition. We've taken 3 examples. Drax on the right-hand side, I just mentioned. You see the outperformance in green of the stock versus the European Utilities Index. The transformation of Drax from being one of the largest coal-fired power generators in Europe and carbon emitters to now a clean power generator based on biomass has led to massive outperformance. Same for RWE, radical transformation in 2018, becoming 2/3 wind and solar through an asset swap with E.ON. Look at the outperformance that this has led to, and a re-rating of RWE, which was back in 2018, a stock trading at about 10 times PE. It's now trading on 18 to 20 times. And NextEra at the bottom, world's largest renewable developer, a traditional US utility in Florida 10 years ago, which has dramatically transformed its business model to now become, which has now become one of the leading renewable and wind developers in the world. And as you can see, again, a massive outperformer versus its own space of US utilities. So that gives you an idea, I think, of what we are looking to identify, those opportunities in the space. Another characteristic, which I think is also an opportunity and largely overlooked, is that the space has now significant inflation hedging characteristics. If you think of January 2022, we were starting a year with the prospect of higher interest rates and high inflation worldwide. Definitely not the kind of context you want for a bond proxy type of sector. And as you could see from the performance numbers I reminded you about earlier, clearly we haven't suffered from that phenomenon. Why is that? Because actually inflation hedging has now become much more significant for the infrastructure and utility space worldwide. First of all, because you have countries where you have direct inflation indexing formulas as part of the regulatory framework. The UK is very much used to that, but a growing proportion of countries are now including inflation pass-throughs. Italy, Portugal, some US states, some Latin American countries. This is a model which is spreading, and obviously in our portfolio, we've been favoring those companies at the expense of others, like the Spanish regulated ones, for example, which don't have that inflation hedging. Pricing power, that's the case of a lot of transportation infrastructure or water business models, environmental services, also very supportive and with a significant ability to pass through inflation. And then some cyclical tilts. That's mostly what has happened to commodities and power prices. It's been supportive, obviously, in the past 18 months, I would say. So inflation hedging possibilities with the strategy well beyond, I think, what a lot of people, generalists, would tend to think. And there is a pretty much the last point here, which I wanted to highlight before moving on to the topic of political drive, which is the valuation gap. Yeah, that's the next page, James. Some people would think that, you know, with the recent performance in 21-22 of utilities infrastructure, the space has become expensive. Actually, you see on the left-hand side that global infrastructure are actually trading very much in line with their past historical range. We're taking the past 13 years here. relative P relative to the MSCI World, premium to the MSCI World, but actually very much in line with the historical range. So to some extent, the phenomenon that I've been describing has hardly been taken into account by the market. But also there's one phenomenon which I believe is bound to be very supportive, is the interest that private equity operators are showing for listed infrastructure. We are seeing obviously massive inflows of cash, private equity operators, but also significant consolidation happening in the space, notably on the back of the energy transition phenomenon. We are listing here the example of the Australian market. Three of the largest listed infrastructure names in Australia got taken out in the past 16 months. Sydney Airport, Spark Infrastructure, AusNet. So 3 takeouts, all of them by private equity groups. And 3 other Australian listed infrastructure names are currently subject to an approach, let's call it this way. So either through expressed intention to bid for the companies like Origin or AGL, or interest expressed by IFM Infrastructure, for example, for Atlas Arteria, which is a toll road operator listed in Australia. We find it quite relevant. We are only starting to see this happening in Europe, but we believe the fact that listed infrastructure are trading in general at about a 50% discount to what private equity operators are ready to pay for similar assets is very revealing and actually extremely supportive for listed valuations going forward if this phenomenon of integration and consolidation continues, which we believe will be the case. So these would be the main points of the opportunity, but I can't finish that presentation without mentioning what you all read in the press about the significant political drive, which also is bound to help our space. The vote of the IRA, the Inflation Reduction Act, by the US Parliament last year is a groundbreaking game changer. $600 billion. The US actually suddenly realizing that out of the 10 largest renewable developers in the world, they only have one ranked, which is NextEra. The other 9 are either European or Chinese. Isn't it highly unusual for such a fast-growing area and a space which is very much driven by new technological improvements, not to see more US presence? I think the Biden administration and US Parliament in general has been very conscious of that. And the vote of the IRA is bound to be extremely supportive to renewables in general, to nuclear in particular, and also to infrastructure with, as we know, massive capex requirements in a large part of the US transportation infrastructure world. What we find interesting is that, as we know, Europe is also considering a similar program as of today. Last year, European governments decided to agree on a Repower EU program, which, to be honest, was very much a sort of a letter of intent to accelerate the development of renewable energy with no clear budget allocated to it. I think what is interesting is that the latest discussions around it are much more promising and could very much mean a significant booster, pretty much equivalent to what the US are doing with the IRA. So those are supportive political drive elements. I know a lot of you would consider political intervention is typically a headwind for utilities and infrastructure. Well, it's become a drive, and a very supportive one, and a tailwind. So I think that's a phenomenon which will only be helpful to the stocks in our portfolio and the universe. That's pretty much it. I think, James, the next page is the portfolio structure and characteristic. I'm showing it, obviously in case there are questions about it, a lot of names which hopefully you will recognize, a lot of large caps, and with some fairly good geographical diversification so as to avoid any individual country risk.